Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
For Alex Steele for the next hour, I'm Paul Sweeney, live here in our Bloomberg Interactive Broker Studio and streaming live on YouTube as well, so you can do that as well. John Tucker, I'm looking at the inflation data. I mean, people tell me, the smart people, that core PCE is is one of the big issues, things that the Fed looks at. You know, month on month, 0.3%, right in line with expectations, in line with last month.
But 2.8%, I mean, that's above. It seems to me that it has stalled there.
Yes, that is a great point. But
kind of well above the Fed's target.
To me, just in my experience, 2.8% is fine. I mean, wages are higher than that. So, I mean, I have more money in my pocket relative to what I'm spending. Just if you look at the real wages, 4.5%, 5%, a nominal wage growth. You know, I don't know. It's interesting here, but I know the Fed wants to go lower, doesn't it? Wants to get down closer to that 2% level.
What do the experts say?
Well, I don't know. I mean, experts say, like, I think they kind of said what you said, which is we kind of stalled here. We've made a lot of, the economy has made a lot of progress in terms of bringing inflation down from that really high level coming out of the pandemic, but maybe this last 50 or 100 basis points is going to be a little bit more tougher. So let's check in with somebody who actually somehow has built a career out of doing this, and that is Ira Jersey, Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. He, like the government bond market that he focuses on, pays a lot of attention to a lot of this macroeconomic data. Hey, Ira, I don't know. I look at the inflation data today. I mean, it's in line with expectations. It feels like maybe we've stalled a little bit in terms of pushing this down a little bit lower, but still, all in all, not bad. How do you think the market's going to look at this?
So I agree. To John's point, you know, it seems like we've stalled here on core inflation, and a big reason for that stalling in core inflation is some of the consumption that's going on. So services continues to be the main driver of that core PCE number being as high as it is, because excluding gasoline and fuel prices, which have come down, which is the reason you see headline year-on-year deflator down at 2.3%. The services continues to grow like gangbusters. So people are still spending money. You look at that personal spending data, and you can see that, you know, people have money in their pockets and they're willing to spend it. So I think overall, this is a steady state from where we were. Now, does this mean that it gives a green light for the Fed to cut interest rates in December? They could if they wanted to, but you could also couch this in, hey, things still aren't bad enough for them to have to cut aggressively. So maybe they could skip this one and then reassess and then go again in January. But you know, next week's payrolls numbers will be the deciding factor of that, more than likely.
Does this beg the question, where is everybody getting this money from? Or are they just charging it on their credit cards?
Well, the simple answer to that, John, is it's coming from wages. So when you look at the personal income numbers that came out today, you have a 0.6 increase month on month in personal income. And if you annualize that, you're talking about well over 5% increase in wages in personal income year on year. Now, some of that comes from government transfers and the like, but a lot of that increase in government transfers really usually happens early in the year when you get cost of living adjustments, the Social Security and the like. So it's really coming. People are spending their extra income that they're receiving. So I don't see how that stops unless the labor market really turns around meaningfully here.
So what else do you think the Fed is looking at here? Because it feels like inflation, by and large, most parts of the economy kind of under control. Is it primarily labor here that they're looking at now, Ira?
Yeah, they shifted that basically 4 or 5 months ago toward, looking at the job market. And it looked like for a very brief period of time earlier this year, in the middle of the year, that the job market was starting to slow very meaningfully. It's a reason why, in a way, the Fed maybe panicked a little bit in September and cut by 50 basis points. You saw some anecdotal data out of the Beige Book and out of some of the other surveys that employment was softening, but you haven't seen that in the hard data. And what you've seen the Treasury market do is follow the hard data, the actual data that's coming out, as opposed to the survey data, which maybe was influenced by the election, influenced by just sentiment of things and the political aspects that were going on, where everyone was so divided and unsure about the future. But that didn't stop them from actually spending money or actually hiring people or giving raises. And you see that in today's data, where personal spending was up 0.4%. That's fine, right? But it's really that income numbers that come up, which also means, ironically, Paul, that you have to remember, that means the savings rate went up. And I haven't dug into the data significantly, but the savings rate now is 4.4%, up from 4.1% the month before. So, that increase in the savings rate means that there's more people putting money into money market mutual funds and into other investments. So that's something else that can prop up some risk asset markets maybe as we move forward, and people are not only spending, but they're also saving.
So the way it works, you got to attract workers. You're going to pay them more to attract them, to keep them. If you're going to pay them more, then you have to raise your prices and pass that along to the customers, who are actually the workers that you just hired, that you're just paying
Precisely.
more. So,
well, yes, John, that's true. But at the same time, what you are seeing is that inflation is going up just a little bit more than consumer spending, right? So what that probably means is that margins are basically being maintained, not necessarily increasing. And in services, and keep in mind, we don't have the same kind of micro level detail in services, because a lot of services are smaller businesses, they're franchises and the like. So you don't have the kind of information like we always here at Bloomberg and a lot of financial market analysts, right? We see the public data that comes in from public companies, and they give us a whole slew of information. But there's most services companies are not those large corporations. They're smaller businesses or maybe franchises of some of the larger corporations that you don't necessarily know exactly what their margins are, exactly what they're charging at the ground level. And that's one reason why the PC data is so important, because it does do a better job than, say, the retail sales figures in determining what services spending and services prices are doing.
Lisa Bromwitz told me this morning that there's a government treasury auction. I don't care about
the
this
7
stuff,
year
Ira.
today, right?
Yeah, it
Talk
is.
to us
Yeah,
about
the
that,
7-year.
Ira, for the folks out there that and tell us why it's important.
Yeah, well, it's important because the government has to fund the massive deficit. So one of the reasons why personal spending is where it is as high as it is because the government transfers money to the household sector, and where it gets that money from is from savers. So it is a bit of a circular thing going on here, where right now 28% of consumption is coming from government transfers. So basically, Social Security recipients, Medicare, Medicaid, and other programs that the government runs and gives transfers to the household and businesses sector. That's contributing about a quarter of our personal consumption right now, which means that it has to be maintained in order for the economy to continue to be as robust as it has been. And the government bond auctions just show how much demand there is for new bonds being issued, and $44 billion of 7-year supply right before a holiday weekend, when maybe a lot of senior traders are off, can create some fireworks and maybe move the market a little bit if demand isn't particularly high. That being said, the last couple of auctions this week have actually gone okay, so I don't suspect that the 7 year is going to be particularly bad. But if you do see a big slip in the amount of demand at this auction, and you wind up with pushing yields a bit higher, that means we have to even pay more attention when we get the auctions next month to see if that is just a one-off blip on a holiday week, or if it's something that is more concerning in terms of demand for new bonds.
Ira, is there a loud and clear message coming from the bond market?
Well, if there is one, it's that hey, the economy is better than a lot of people thought it was just 6 months ago, and the market right now is signaling that it doesn't expect a very rapid pace of cuts, or cuts below 4%, for example, on the Fed funds rate right now. So it's the market is expecting more cuts, but it's only expecting maybe another 50 to 100 basis points at the most in terms of interest rate declines, because the economy has been so strong, and that is confirmed by this data, which is the first data that we get for the fourth quarter, of course, and the fact that it is so strong, I think, bodes well for things like GDP. You're going to see GDP now forecasts get updated after this data, and they're all going to show that the fourth quarter is pretty good. Atlanta Fed, Cleveland Fed, there's a couple of different people. Bloomberg Economics has their own nowcast as well. So take a look at those and see, and you're going to see that the market right now is suggesting that that the economy is reasonably strong, and this data just confirms that.
We just had an election, and I don't think that's the message I took away from the election results.
Yeah, that's obviously there was a lot that probably went into the election, but clearly there were people who maybe blame the Biden administration for the inflation that we had, right? And that is backward looking, not forward looking. But the economy is not doing badly, regardless of who's in the White House, and I suspect that that could certainly change, right, going into 2025. But at least where we sit right now, over the next 2-3 quarters, I don't think that we're going to wind up seeing the recession that a lot of people, including myself, thought we were going to see by this time. But by this time, when we were looking back 18 months ago.
Ira, great stuff. Thanks so much for joining us. Ira Jersey, folks. He's the chief U.S. interest rate strategist for Bloomberg Intelligence, safely ensconced down in the Princeton, New Jersey offices.
There's like nobody in that office.
It's a great office, by the way, and they redid it. It's an awesome place for those folks to work down. A lot of good folks down there in Princeton.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
John Tucker sitting in for Alex Steele. And I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube, so you have to go over to youtube.com, search Bloomberg Podcast, and that's where you will find us. I don't know, John, we're getting some pretty solid economic data. The earnings that we just kind of finishing up were pretty solid. Expectations are still pretty positive for earnings. I got a Fed that I think is cutting rates. I think that's all pretty constructive for markets here. Let's check in with somebody who does this stuff for a living. Sylvia Jablonski, Chief Executive Officer and Chief Investment Officer, Defiance ETFs. Sylvia, I'd love to just get your thoughts, just broadly defined to start off here, about where you think we are with some of just kind of the market outlook as we think about 2025. Where are you guys in terms of thinking about where this could go?
Well, good morning and happy early Thanksgiving to you both. I think that the markets are probably poised for a small rally into year end. We'll probably, go back to these highs that we've tested this year and see that happen in the next month or so. You had a great setup there, right? The Fed has cut already and is potentially on a path to continue cutting, or at least holding and not raising. So, financial conditions should be a little bit better for corporations. We have a president that's coming in that's pro deregulation, market friendly, tax cuts, things like that. So that tends to, do well for markets as well. So, my view on this is that for the next, call it 18 months or so, I think we're in a pretty smooth spot, barring any kind of major changes to fiscal monetary policy, to see the S&P and the broader based indices trend upward.
How much money is on the sidelines at this point, Sylvia?
Yeah, a lot. I think, to the tune of 7 trillion or more. And I think that that's because, a lot of this kind of risk off mentality came about in 2022 and didn't come back into the markets, particularly when, 5% is the type of interest rate you're getting on your cash. And so I think that's changed now. The S&P is going to be probably up 25% or so this year. All of a sudden, it really makes sense to put some of that dry powder to work in the markets. And I think, we're going to start seeing that come back in the next couple of years. And I think, that with high single digit corporate earnings outlook, cash coming off of the sidelines, that bodes well for at least a pretty decent average rate of return type of S&P 500.
Sylvia, just with your ETF platform, I always love to just ask folks like you that are seeing the flows out there, where are the flows going in your ETF platform?
Well, the most popular ETF that we have, and potentially that planet Earth has right now, because I see everybody writing about it and talking about it, is the leveraged microstrategy ETF. So we have a 2 beta microstrategy ETF, ticker symbols MSTX, and it's seen almost a couple billion of flows just since its inception, which is basically September, late August. And so that's just been a wildly popular trade. And then the election results and this idea around, again, deregulation and crypto adoptance really helped that ETF. It's been wildly popular there. Second place, though, is quantum. And there are all these little stocks out there that people don't talk too much about, but, IonQ, QBTS, like some of these small quantum computing companies, we have them in our quantum ETF. And so, a lot of flows have flowed into there as this AI evolution continues to grow.
That's the little companies. I was fortunate enough to see the up in Sleepy Hollow, the IBM Research Center. I think it's the Watson Research Center.
They've got a huge quantum center. Yeah.
And they've got this thing it looks really cool. Most of it is just cooling coils. It's like a big air conditioner, a big freezer for what is essentially a chip like this big, and they have to keep it just above absolute zero, which is really, really cold. I think of quantum computing, though, Sylvia, as sort of like, fusion energy. It's going to be another 5-10 years, and then we get there, it's going to be another 5-10 years, et cetera, et cetera.
Yeah, I think, the broad topic and idea for us is more around the idea of supercomputing, machine learning, AI plus quantum computing, but we're kind of referring to the companies that are responsible for those coolers that you saw, right? And they're kind of feeding the hyperscalers and their AI and machine learning R&D, and they provide these cooling system or else basic quantum computers for them to kind of run their data on. And so it does exist already to some degree, right? Like you have banks running supercomputing to detect risk. It's used in cryptography already. Drug research has some level of machine learning and supercomputing, but it's the idea that these quantum computers will come in and allow this to be done more efficiently and more quickly to make it, kind of more commercial is what's going to play out, I think, in the next few years.
And if you have an algorithm, you can actually send it to IBM and they will run it for you.
Is that right?
Clean up all the mistakes that invariably happen too.
Interesting. Hey, Sylvia, talk to us a little bit about XMAG, XMAG.
Yeah, so if you're of the mindset that the Mag 7 are kind of at their highs and have high valuations, and you're looking to put that $7 trillion to work in the market, but you're kind of worried about those names not being the leaders, we launched XMAG, so that's the S&P 500 minus the top 7 tech companies, right? And so the thought there is, number one, diversify. Small caps, domestic policy, things like this might behoove the rest of the market, sub Mag 7. Again, you have winners in there. In the other 497, names like whether it's Costco or Broadcom or Vistra, Constellation Energy, like all of these stocks that are doing quite well this year and aren't talked about. We kind of let them fly because it's a market cap weighting, but that's the diversification trade. And the second argument there is, we love the Mag 7. We just know you already have them. If you own S&P, a third of that is the Mag 7. So you've got it somewhere.
You're mentioning tax cuts, et cetera, so forth, deregulation, all that stuff. How much of that is actually baked into company forecasts right now?
I think, probably not much. I don't know. I think the market was anticipating this winner, but then there was enough of uncertainty where you kind of saw things like the dollar and gold and commodities in the 10-year pop around a lot before the election. So I don't think any of it was fully priced in. I think that post-election pop kind of gave us some of that, but longer term, I think this will, play out as companies actually save this money and expand balance sheets and, kind of have better taxes, more CapEx, hopefully, and some growth.
All right, Sylvia, thank you so much for joining us. Always appreciate getting a few minutes of your time. Sylvia Jablonski, Chief Executive Officer and Chief Investment Officer at Defiance ETFs.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Geopolitical front. Some good news coming out of the Middle East. Lebanon ceasefire starts after Israel and Hezbollah reach a deal. That's a good news. Let's break it down a little bit and see what it means for that part of the world. Ned Lazarus, Associate Professor of International Affairs at George Washington University down here in Washington, D.C., joins us via that Zoom thing. Ned, talk to us about this agreement. What does this agreement say? What does it do? How is it important for that part of the world?
It's extremely important and has the potential to be a turning point in what has become the most active front of the war. It sets out a 60-day period during which Israel and Hezbollah are supposed to cease fire. And so that means ceasing the bombardments of many areas in Lebanon, ceasing IDF troops that have gone up to the Litani River in Lebanese territory, ceasing the advance of IDF troops, and ceasing Hezbollah's continued missile fire on Israel, firing dozens, often hundreds of missiles every day, despite all of the blows that Hezbollah has absorbed from Israel in the last few months. So the fire is supposed to cease over a 60-day period. The Israeli military is to withdraw from Lebanese territory back to the international border, and the Lebanese army is supposed to deploy in southern Lebanon. So that is in tune with a previous UN resolution, 1701, UN Security Council resolution that ended the 2006 war between Israel and Hezbollah. But the Lebanese army never did deploy, and instead Hezbollah built an enormous militarized area right up to the Israeli border, including tunnels, including massive amounts of munitions, all set for the order to invade northern Israel. So what the Israeli military has sought to do is to destroy Hezbollah's very elaborate setup for an invasion. And what is meant to happen now in these 60 days is that Hezbollah is meant to not return to southern Lebanon and not to rearm. The test will be if this is actually what happens, because the chaotic reality may put the best of intentions off course. Right away after announcing the ceasefire, there were celebrations of relieved people in Lebanon, and protests from many of the displaced residents of northern Israel who don't trust that the agreement will in fact be enforced.
Yeah, this is Hezbollah and Lebanon. What about to the south with Gaza? What's happening on that front? Does this cover anything like that, or could it be used as a template for something with respect to Hamas?
Well, President Biden certainly expressed that hope in his announcement of the ceasefire, and the Israeli families whose family members are being held hostage by Hamas have repeatedly expressed both that hope and also some anger, saying that similar terms could result in a deal with Hamas that would free their loved ones from captivity. And so there was anger at the government that it has prioritized the northern front and not the release of the hostages, while sort of accepting terms with Hezbollah that the Israeli government rejects with Hamas. So we will see if there is renewed momentum. Hamas has also issued a statement that it is that it is ready for a deal. So that may perhaps just be meant to put pressure on the Israeli government, right? Because the far right elements in the Israeli government, on which Benjamin Netanyahu's coalition depends, do not really want any kind of hostage deal. They want to reoccupy the Gaza Strip permanently.
Professor, what was the role of Iran in this ceasefire agreement, and what do you think the role will be going forward as it relates to Gaza?
So the ceasefire agreement is binding on Israel and Hezbollah. Hezbollah is the armed actor that needs to cease fire. but it's not signed by Hezbollah, and it's an agreement between Israel and the state of Lebanon. It is simply understood that Hezbollah must follow this agreement and assents to it. And it's a similar thing with Iran. So Hezbollah is a proxy of Iran. It is armed, funded, trained, supported by Iran. And so without Iranian consent, this agreement wouldn't be happening. I think it's very clear that Israel's military campaign against Hezbollah in the last 3 months has been devastatingly effective, and has forced the organization to accept terms that it probably would not have wanted to. Nonetheless, Hezbollah is apparently putting out messages in the media celebrating its great victory today. But in reality, it's very clear what has happened. Nonetheless, Hezbollah remains a potent organization, and again has continued to fire hundreds of missiles into Israel every day during the past few months.
How many caveats or provisions does this agreement have? Those aren't the usual words you'll toss around in diplomacy with agreements such as this, but is there a chance that Israel's military is going to strike at the slightest provocation and send things spiraling back to square one?
The key caveat is in a side letter between the U.S. government and the Israeli government, and that caveat says that if Hezbollah attempts to rearm, attempts to infiltrate personnel into the southern Lebanon area on the Israeli border, that Israel retains the right to strike, to use military force to prevent the reemergence of that threat. President Biden explained that by saying Israel has the right to defend itself as any country does, and that Lebanon has the right to its sovereignty. So that's in a side letter between the U.S. and Israel, because the Lebanese government would not sign off on an agreement that included an inherent violation of its sovereignty.
All right, Ned, thank you very much. Really appreciate it. Ned Lazarus, he's Associate Professor of International Affairs, George Washington University down there in Washington, D.C., getting the latest analysis of this ceasefire between Israel and Hezbollah, which is good news for that part of the world, and we'll see how much more we can get. This is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Bryan Whalen joins us here in our studio. He's in New York. How about that? Bryan Whalen, Chief Investment Officer and Generalist Portfolio Manager at TCW. Hey, Bryan, when you and your team got up the day after the election, you centered around your big conference room. Yeah. Did you all look at each other saying, do we have to change anything here? What just changed, if anything, overnight? How did you guys?
We did. In fact, we kind of scratched our head a little bit because we felt like the market's reaction was just kind of a knee-jerk reaction. It felt like, I don't know if it was the holidays coming up, it felt like the market hit the easy button and just wanted to take everything kind of on the surface, which was like, okay, we're going to have tariffs, 20% on the rest of the world, 60% on China. We're going to deport tens of millions of people, and inflation's going to jump up. We sat back and we said, you know what? Actually, inflation was running at about 2.2% when Trump came into office the first time, and through his presidency up until the pandemic, it actually went down to 2.1, and that included tough immigration policies, that included tariffs, and then on the growth side, the market all of a sudden said, oh, well, my gosh, we're gonna cut corporate taxes, we're gonna maybe do this adjustment to the SALT. Matt, I know that's near and dear to your heart. It's huge for me, right? Yeah. And all of a sudden, we're gonna have higher Treasury issuance and higher budget deficits, and Treasury yields have to go higher. We sat back and said, wait a minute, the first time Trump came into office, it was 100% debt to GDP with 3% budget deficits. Right now he's come in with 120% debt to GDP. The budget deficit's over 6%. Yeah, you've had a Republican sweep. However, the margin in the House is not that great. There's certainly budget hawks out there. And so, at the end of the day, we just didn't feel like, the narrative or the landscape had changed that much, and that whatever was going to get done was going to get done in probably a diluted manner from the administration. And what was going to be effective was probably going to be something later next year, if not 2026. And so from our perspective, we felt like it was an overreaction, particularly in interest rates. And we'd rather kind of get back and focus on maybe the economic trends that were in place before the election day.
It's interesting because I always put the question, usually to stocks guys, on my TV show, Bloomberg Open Interest, weekdays 9 to 11 a.m.
Boom.
I always listen. Yeah. Okay.
So I always put the question, would you rather be in stocks or bonds going into Trump 2.0? Because he's going to, he says, deregulate. He's going to cut taxes. He's going to, raise tariffs. And it would seem that stocks are the answer. But right now, the S&P is yielding like less than 4%, right? And the 10-year is, 426 right now. So what do you think?
I think that, the knee-jerk reaction was, bonds went down in price and stocks went up. And now I think cooler heads are prevailing. And they're kind of looking at what I said earlier, which is saying, you know what, like maybe the story right now should be like, what was the economic trend in place going into November? And, we can talk about that. And look, at the end of the day, Trump is Trump. You're going to get a lot of volatility. And, let's not forget he's a commercial real estate guy. Donald Trump wants lower interest rates.
Right.
That's good from his perspective. And I think the administration
wants them, but can he get them? I mean, you look at Dots Go on the terminal. Dude, if you look at Dots Go right now, and then you punch in Fed funds futures, the market is pricing a terminal rate of like 4%, and the Fed has penciled in a rate of less than 3.
Right. He's probably going to get them. Unfortunately for the administration, he may not get them in the way he wants, which may mean that some of the softening trends we've seen in the economy and the labor market that were in place before the election, from our opinion, they're more likely going to be what you want to look to in terms of direction, which means once we come into the new year, we could be in an environment where the economy is slowing. The Fed may have to lower rates further than the market's expecting, but that's probably going to be coinciding and due to a slowing economy, which is not necessarily the best thing for the administration.
So where, given that kind of backdrop, do you guys see value in the fixed income market these days?
We love for the bond nerds, it's the front end of the yield curve. Basically, if you think about, let's put the yield curve into two pieces. Let's call it the front end, which is like the 2-year treasury and the 5-year treasury, and then you got the long end. That's kind of like, let's call it the 30-year treasury out there. We think the 30 or TCW, we're kind of looking at the math and the fundamental kind of bottoms up work and say, there's a lot of questions on the long end. Like maybe we do have a lot of treasury issuance. Like there's a lot of factors, maybe overseas, central banks may sell it. Like a lot of factors can influence that. Where we would rather kind of tie our clients' money is to the Federal Reserve, what they're going to do with the Fed funds rate, and that will highly influence what happens with the 2-year and the 5-year. And right now, those yields are about 4.2% plus or minus. So first of all, you're getting paid a good yield or a coupon to kind of sit there, kind of like a cash-like investment. And then if we're right, and the Fed actually has to lower rates, not to what the market expects, which is about 4%, to maybe 3% or even lower, you're going to get a really good price return, and that prices are going to jump up when yields go from about 4.2 today to something closer to 3 or even below that.
But the best performing sectors just year to date have been U.S. high yield and U.S. leverage loans. Does that surprise you?
Are you on IN Go?
IN Go.
Yeah.
Yes.
Does it surprise? When you look at equities at 22 plus price to earnings, when you look at the VIX at 14, does it surprise me? No, because it's kind of in line with other things going on in the marketplace. But that's extremely expensive. Like you are not getting compensated to take risk in the high yield bond market right now. You get about 2.6% of extra yield.
It's crazy. It's crazy.
Tight. Just historical levels are north of 4%. So basically, what the market's telling you, at least in the high yield market, is that it's going to be a no landing. There's not going to be volatility. Everything's going to be smooth sailing for a year plus on out. And we're willing to kind of position against that.
Yeah, I think there was a Bloomberg story just a couple days ago about building up short positions in that debt. By the way, we are always pimping Bloomberg functions. That's why IN Go. You know them all, right? But the
How about WIRP? How about WIRP?
WIRP for sure is
the
one.
Best.
I absolutely love WIRP, IN Go, ECTR Go is one I've been pimping out today. I wonder how focused you are on the U.S., or do you also cast your gaze abroad? Because someone sent me the Feta Brie spread today, which I thought was interesting. So French 10-year yields are about to be higher than Greek 10-year yields. And I mean, those of us old enough to remember the European debt crisis, that's insane, right? Athens was burning.
It is all over the map. In fact, Greece is actually paying down debt.
Yeah.
France is having their government's probably going to dissolve. I think actually, yeah, we do stuff all over the globe. Like actually, just this morning, we were buying French debt at 86 basis points over boons, which is quite a bit. And then other areas of value, and we love the pound. We think that currency looks attractive versus the euro. New Zealand, talk about cutting interest rates. Zealand just cut interest rates 50 basis points overnight. They're still at least 200 basis points away from neutral. So, given except for Japan, there was this kind of developed central bank hiking throughout 21 through 23, and now we're on the other side of that. We're on the back nine, and interest rates globally, except Japan, are coming back down, and they're creating some interesting opportunities, a lot of cross currents out there to do things not just in the U.S., but from a rates and a currency perspective all over the globe.
Yeah, that's the exciting part of the story. And do you see any significant divergence there? I mean, at the beginning of the year, we all thought everyone was going to be on a cutting cycle together. And now, I mean, is it still the case, or do you expect some banks to be cutting more than others to be holding back?
Some will cut more than others. The ECB will, and I said New Zealand will probably cut more aggressively than others. Australia is going to hang back a little bit. Inflation in Australia has not come down. Actually, growth looks decent there. And then you look at places like Japan. Like Japan's behind the curve. I mean, what an incredible turnaround story there. So they're going to have to hike rates a lot more aggressively, we think, than the market expects. And when you talk interest rates, you have to talk about currencies.
Yeah, absolutely.
So when we look at that, it's like the yen looks like an incredibly attractive value. The dollar's been on a run,
and it's
the last
so
few
weak.
Months.
I mean, you can buy more than 150 yen for a dollar.
But I think both from an economic perspective, from an interest rate perspective, and a growth perspective, you've got three nice tailwinds behind the yen right now, and it's gone against you for the last month. But it's kind of value investors. What we think is like, that's just a buying opportunity. You're getting it at a better price right now to purchase that currency.
How about emerging markets? Do you guys traffic in that a lot? Or?
All over. And yeah, talk about the election and tying it back to the emerging markets. Like great opportunities, cross currents, like with regards to tariffs and immigration and the currency volatility. It's created opportunities, kind of bottoms up, kind of issue selection opportunities, and kind of where we've been favoring is economies that are more in the emerging markets that are more idiosyncratic. So kind of less exposed to generic like tariff increases on high exporting economies, rather the other side where their economies tend to be more isolated and they have very favorable fundamentals behind them.
Damn, I want to come back as a macro trader, dude. That's where all the action is.
I know.
Yeah.
Why are we stocks guys?
You could be
so
the next,
boring.
You could be the next Treasury Secretary.
Yes,
you could be a macro.
I probably have a better shot at that in this administration than I ever have in my life.
Exactly. Just the odd, unique calls. Bryan Whalen, thanks so much for joining us. Bryan Whalen, he's a chief investment officer and a generalist portfolio manager at TCW, based out there in Los Angeles, but in our New York studio
Slumming
today.
it here in New York City.
Exactly. We're going to just get rain on the parade tomorrow.
Still capital of the world, right?
Yeah.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
One of the most widely read stories on the Bloomberg terminal has to do with some of the bigger names out there in global Wall Street, so that's not a surprise. BlackRock, Vanguard, accused of antitrust violations by Texas. What's going on down with our friends in Texas? Peter Jeffrey joins us, Bloomberg News Legal Editor. Peter, what's going on with some of these huge asset managers and our good friends at the state of Texas? What's going on?
The asset managers have belonged to groups that are seeking to mitigate climate change by reducing, for example, coal output. Some of them have drifted away from these groups, but Texas sued this morning in federal court, claiming that the asset managers are effectively colluding to depress the output of coal and therefore raising energy prices on consumers in the states that sued, including Texas, West Virginia, Montana, Alabama, and so forth, Republican-led states.
How much of this is just kind of loony Ken Paxton, Republican Texas politics?
Ken Paxton does sue a lot, but it's an interesting suit. It's 100 pages long, and I think, just looking it over, they're going to have to show that it was the actions of BlackRock and State Street and Vanguard themselves. They're pushing these portfolio companies to cut down on their coal output, the states are going to have to show that that is what led to the reduction of the coal output, it seems to me, and therefore raise prices on consumers. So to your question, yes, Ken Paxton does sue a lot. Yes, he's got to show all of that, as well as the other states have to show.
I should point out he's the Attorney General.
The Attorney General of Texas, right.
Who himself went through an impeachment proceeding and prevailed.
But I will say that it's a carefully, I've been looking at it just this morning, it's a carefully written, fairly well-structured suit presentationally. Now, whether it can prove the allegations is an open question.
I always find that funny. I'm learning from Alex Steele, who's our expert here on energy. You think of Texas, you think of oil and gas, but they're also the biggest wind farm people, the biggest solar places are down there in Texas. I mean, so they are cranking out a ton of alternative energy.
And in fact, it's those alternative sources that are partly playing a role by competing with coal. One of the forces that may be depressing coal output as well. So again, to show this connection that it's Larry Fink who is driving down the coal output and up the prices is the challenge for the states that are suing. It's quite an interesting suit.
We also know from having read the grid that Texas has its own grid. They're not hooked up to the rest of us.
Right.
That fiercely independent streak that they have.
Right.
Exactly.
And coal output in Texas, I think, is down to 10% of its energy output from 18% just 4 or 5 years ago, if I've got those figures right. So there's no question that the coal output is diminishing, but what's causing that will be one of the crucial links to show in succeeding in this suit.
So what are these asset managers, have they said anything in response to these suits?
So far, no. They haven't yet given us their position. We're waiting. We're hoping to get that position and put it in an update in our story. But I'll tell you what they're asking the court to do. They're asking the court, it's kind of interesting, one of the possible asks, if necessary, is asking the court to force these giant money managers, the top 3 U.S. money managers, to divest themselves of these coal holdings. We'll see if it happens, but that is one of the things the suit seeks.
Do they still shake in their boots when this happens, or are they sort of like the asset managers kind of fighting back?
Well, that's a good question. I mean, there's been so much litigation around ESG, and some money withdrawn because of ESG. But I think at this point, they'll look at the suit, they'll read the suit carefully, they'll be prepared. I don't know if they're shaking in their boots.
Yeah, it's. I'm from Vanguard or State Street. I'm like, I'll go against the state of Texas.
One of the federal statutes that the suit invokes is the Clayton Antitrust Act from 1914, and what that says is that if any action that you take, for example, in shareholder proposals, voting on shareholder proposals, that has the effect of limiting competition is illegal.
All right, Peter, thank you so much for joining us. Peter Jeffrey, he's a legal editor for Bloomberg News, joining us here in the Bloomberg Interactive Broker Studio.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern, on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.